Okay, so hello, my dear accountants. I hope my voice is audible. The PPT is visible. Yes. Okay, very good. Today is our last discussion on the crash course on fast track. So, in a way, let's say that is begin end. If couple of standards are remaining, Ind AS 33 earnings per share is one of the slightly important technical standards. First of all, how to remember this number easily? Is 33. Very easy. What is the name of the standard? Earning per share, right? So what is the first letter? E. Last letter E. Just turn it backwards. It becomes 3 and 3. Ind AS 33. That is what is the solution is all about. Another test paper I'm not giving. Just before exams, maybe in the month of October first week, I will release one mock paper for FR as well as SFM based on my pattern analysis. Okay, so based on the pattern analysis and my predictions, what could be the important questions for examination, I will release it in the month of October. That's what I'll be doing. Remaining mock exams will be available in the institute. You can take it. So my questions will be based on my expectation, based on my analysis. I will release. So let's go forward then. We have three types of EPS: current period EPS, previous year EPS, and then future year EPS. Answer key for that list series also I will share it today after this. I will share. Don't worry, I'll definitely. I don't have too many problems in this standard in the material, but I would like to make sure all the varieties are covered. Let me do that. First, we'll compute the basic EPS. One second. Okay, let's understand the basics now. Why EPS is important, I'm not going to discuss. You are SFM students, you know the best. Let's focus on the technicalities aspects of it. So basic EPS. How do we calculate? Earnings available to equity shareholders divided by number of equity shares outstanding. We don't say number of, we say weighted average, but let's say number of equity shares. Now, few small points to be understood. Is profit after tax same as earnings available to equity shareholders? The answer is no. How do you calculate profit available to equity shareholders then? Then what we do is profit after tax minus preference share dividend. And what nature? To be specific, it is cumulative in nature. For cumulative preference share dividend, whether declared or not, we have to subtract. For non-cumulative preference share, only if you have subtracted, only if you have declared, only then it comes to this. If preference share dividend non-cumulative nature, if it is not declared, it will not come here. Only the year when declaration comes, that year only it will be part of earnings available to equity shareholders by way of reduction. But one more technicality is important. Preference shares may be in the nature of debt or equity, right? Preference share may be in the nature of debt or equity. The preference share in the nature of debt, no need to adjust, no need to do PAT minus preference share dividend. No need, you need not do it. Why? Because the PAT would be already adjusted. PAT would have been already adjusted for it. Because when you know in the nature of debt, you would have done amortized cost method, where you would have calculated opening balance, on that interest, the preferential dividend minus payment, closing balance. So what is the debt element? Obligation of the entity towards preferential dividend is already considered as debt element, right? So to compute profit after tax, that dividend would have been taken as interest expense, not interest expense, finance cost. So PAT would be already recognized, adjusted for the finance cost. And for equity dividend, in the nature of equity, we follow this. Equity dividend, now we don't subtract. In the nature of equity, we have to follow this. So this is earnings available to equity shareholder. Sometimes some expenses will directly come in the balance sheet without coming in the P&L account. I'm not talking about OCI. For example, share issue expenses would have been directly adjusted in security premium. So few elements which are directly taken in other equity without passing through P&L account also should be considered for that year for the calculation of E. Okay, so this is regarding the numerator piece. Coming to denominator, so many things to be considered. Number of equity shares. If it is partly paid up shares, we take it proportionately to the extent of paid up, like a equivalent number of shares. Then issued during the year, issued during the year, then again proportionately for number of months outstanding, then business combination, shares issued from the date of issue, convertible debentures from the date of conversion, right shares from the date of issue of rights. What is important is bonus. It is taken from the beginning. Bonus shares, irrespective of the date of issue, you have to consider as if it is from the beginning. Date of issue of bonus does not matter. We take it from the beginning itself. Please tell me, do you want any example for this proportionate issue during the year to compute the weighted average number of shares? You want a simple numerical, or do you think you can understand it? If you want, I'll give a quick numerical. Otherwise, I'll go to the right shares and bonus share. And of course, convertible debit. You want a numerical for partly paid up issue during the year? Okay, quick example. Okay, so suppose if it is like this, let's say, okay, so on April 1st, 2019, let's say company 1,20,000 shares of 100 each, 50 paid up. And on September 2010, 1st of September 2020, 2019, they called up the balance and everybody paid. Everyone paid except 24,000 shares. So this is one partly paid up and issued during the year. Both are there. So how do we calculate in this manner? How do you calculate in this case? So it can be done in 2-3 ways. I'll give the simplest possible. In a time travel, I'll explain. So on 1st of April 2019, you had 1,20,000 shares, 50 paid up. So proportionately we take 50 by 100. Till when? Till 1st September 2019. So for a period of April to September. So April, May, June, July, August. 5 months to 5 by how much you get here? 1st of April to 1st of September. 1,20,000 into 50 by 100 into 5 by 12. 25,000. 25,000. Now balance 1,20,000. 1,20,000. Okay. Now on 1st of September, what happened? That 1,20,000 shares there, no, it was 50 paid up, became 100 paid up because balance was called up, everyone paid. So 50 paid up became 100 paid up. For everybody? No. For everybody except 24,000. So 1,20,000 minus 24,000, 96,000 shares became fully paid up. And balance 24,000 shares who did not pay balance amount, they continue to be partly paid up. They were partly paid up, they continue to be partly paid up. So on 96,000, fully paid up 100 because first 50 was paid up, now balance 50 was paid up, fully paid up for a period of 7 months. 96,000 into 7 by 12. 56,000. And for this 24,000 partly paid up continues. So 24,000 they paid only 50 rupees, 100 for 7 months. 7,000. So total, if I add all 25 here and 56 plus 7, so that comes to 88,000. 88,000. But do you understand here what is the logic of considering proportionate number of months? What is the logic? Because in the profit after tax we divide by number of shares. Number of shares. Meaning what? Number of share is like our source of income, a source of finance, and profit after tax our result. Using our number of shares, using our source, we have generated profits. So numerator is profits, denominator is like a source for us. Now during the year, if I've issued the shares, that means source has come for us during the year. Source has come for us during the year. Therefore, the profit also would have started only after we start making use of the money. Since the source of money came between the year, The profit should start from that point onwards. So numerator would have been for that month, that proportionate after the shares coming to picture. The number of shares also should be after the date on which the source is coming to picture. It's a matching principle. Are you able to understand? When my number of shares coming to picture, only from that point I can make profit by using that. When number of shares are during the year, my profit also would be during the year. My profit during the year, therefore my number of shares also should be proportionately for number of months. So both can be matching in. Hope you understand this logic. The reason why I'm explaining this logic is because it will help us in ascertaining bonus shares. Hope you are clear in this example. Shall I go to bonus shares? Okay. Let me go to bonus shares now. Okay. Now tell me, bonus shares, what is the impact on shareholders' wealth? What is the impact on shareholder wealth? In the sense, when bonus is issued, shareholders' wealth will increase, it will decrease, or it will remain same. Impact on shareholders' wealth. What do you think? The bonus shares will not have any impact on shareholders' wealth. Why? Suppose share price is 30 rupees. You issue bonus, the ratio 1:1. Share price will become 15 rupees. Now, when share price become 15 rupees, you should not think, oh, your share price reduced. No, earlier you are having one share of 30 rupees. Now you will have two shares of 15 rupees. Overall will be 30 rupees only. Shareholders' wealth is not affected. Sir, then why bonus shares are given? Same logic as in a rupee, you do a change, right? You do exchange, you do change. Like, which is better? One 2000 rupee note, or you have 20 100 rupee notes? One note or 20 notes? Both value wise same only, no? 2000, 2000. Value wise is not different. Value wise same only. So, the bonus share issue is like this. Whether when before bonus you are having less number of shares, more value per share. After bonus, more number of share, less value per share. Holding remains same. Then why bonus is done? Is it to cheat people? Is it to confuse people? Is it to give a wrong notion of making profits? No. This is because of the same reason. Is it better to have one 2000 rupee note, or is it better to have a 20 100 rupee note? When you want to transact, it's better to have a 20 100 rupee notes, because easy to transact, easy to give, easy to change. Because 2000 rupees note means for having coffee, tea, 5 rupees you have to pay. 2000 rupees cannot manage. Same logic. To induce liquidity into the market, bonus shares are issued. So what is the impact of this? Issue of bonus shares, issue of bonus shares will not have any impact on shareholders' wealth, on company's net worth, or on company's earnings. So bonus impact is no impact on shareholders' wealth or company net worth or on earnings. No impact. So when the formula is profit after tax divided by number of shares, when you don't have any impact of profit, meaning what? By issuing bonus shares, company did not make any profit. Company is not getting any profit. That means profit is not affected by number of shares. So profit is not affected means number of shares also, how can I take it as proportionately? Company is not receiving a source. Bonus is not a source for the company. But still, as on date, it is pending. So what we should do? We consider from the beginning. We consider from the beginning. One more numerical example I give. Suppose company had 1 lakh rupee profit the previous year. In the current year also company made 1 lakh profit. Number of shares, they had 10,000. So EPS is 10 rupees. Now they issued 1:1 bonus. So 10,000, 10,000 more bonus they issued. So total number of shares become 20,000. The EPS become 5 rupees. Can you say, oh, this company share price has fallen, this company's EPS has fallen, very bad company. They got 10,000 more shares, but the profit they did not increase. Very bad company, bad performance. Can you say? No. Why? This 10,000 is not a source for the company to make profits. The value of 10,000 and the value of 20,000 both are same. You cannot make more profit. So what do? I cannot change the current year 20 to 10,000 because as on day 20,000. So what do? Previous year 10,000, I'll make it as 20,000. So what will happen? 1 lakh divided by 20,000, that is also 5 rupees. This also 5 rupees. Now you can say company has not changed its operation. No change in performance. This 5 rupee of current year is called as basic EPS. Bonus shares are considered from the beginning of the issue. 10 rupee, what is reported in the previous year? Previous year reported EPS. What is the new 5 rupee what we got? New 5 rupee what we got is in the current year financial statement. To have a meaningful comparison, we change the comparative number. We change the previous year number. We don't go to previous year financial statements and change it. We don't do it. The comparative what we have in the current financial year as a comparison, the previous year figure, the current previous year column what we have in current year financial statements, for the purpose of better financial statements, we revise, we restate. That's called as adjusted EPS. So adjusted EPS means it's an amount relating to the previous year, but in the current financial statement, restated for the purpose of better and meaningful comparison with current year EPS for the events such as bonus shares, right shares, etc., which don't have any source of finance for the company. It can be bonus shares, it can be right shares to an extent, it can be stock split, reverse stock split, those kind of elements. Are you clear on the bonus? I'm not doing any problem. I'm only discussing the theoretical aspect. So bonus shares, the impact is for basic EPS from the beginning of current year. For diluted EPS, not diluted, for basic and diluted everything, for adjusted EPS, beginning of previous year. But sometimes we prepare 3 financial statements, a change in accounting policy, restatements. So what about third column? Opening balance of that year. So it's beginning of earliest periods reported. If 3 financial statements are there, the beginning of that year, whenever it was there. Actually, you can say bonus is issued, assumed to be issued from the beginning of the company was formed. Like that you can think. From the earliest period possible, that is bonus share. Okay, got it? Let me go for right shares now. Right shares. Right shares for basic EPS, if it is at the if it is the issued at the current year, for basic EPS up to the date of right issue and after the date of right issue. Up to the date of right issue, we compute like this: number of shares before right into m by 12, number of months, into adjusting factor. Adjusting factor, I'll tell you what is adjusting factor. After the date of right issue, it's calculated by number of shares including right into m by 12. Adjusting factor now does not matter. For adjusted EPS, that is for previous year. For previous year, number of shares, obviously previous shares means before right. Number of shares before right multiplied by adjusting factor. Basically, right shares means what? Shares issued to existing shareholders at a concessional price. In the concessional price, there will be free element, there will be bonus element. That bonus element is what is adjusting factor is all about. Let me give an example. Okay, what is adjusting factor? Adjusting factor is calculated by fair value of share before right divided by theoretical x right price, basically fair value after right. Theoretical x right means excluding right, not the right of your x, excluding right, theoretical x right price per share. That means after right. Numerator is before right, denominator is after right. What is theoretical x right price? How do you calculate? Number of shares before right multiplied by fair value plus right shares multiplied by right price, right issue price divided by total number of shares. Divided by total number of shares. Let me give you an example, numerical. Okay, let's say 1/4/2018 number of shares were 5 lakh. On 1/6/2018, they issued right shares 1 lakh at the right price 15 and fair value before the right, fair value before issue of right is, let's say, 21. How are we going to calculate? Okay. So what is going to be theoretical x right price here? Theoretical x right price. Theoretical x right price. We had 5 lakh shares. fair value was 21. We issued 1 lakh shares at 15 rupees. So total net worth is numerator divided by denominator total number of shares is 5 lakh shares plus 1 lakh, total 6 lakh shares. Please compute this. Tell me how much you get. 5 lakh into 21, 1 lakh into 15 divided by total 6 lakhs. ₹20. 20 rupees. So what is the adjustment factor is going to be? Fair value before the right is 21, after the right is 20, so 1.05. So 0.05 basically represent bonus element. I'll prove it later. Okay. So for the purpose of computing current year EPS for basic EPS and for adjusted EPS. For adjusted EPS, what will be your number of shares going to be? Previous year 5 lakh multiplied by adjusting factor 1.05, 5 lakh 25,000. For basic EPS, what do? We do 5 lakh, again number of shares equals. We do 5 lakh into 1.05, but only up to the date of issue. Date of issue 1st of June, so 2 months into 2 by 12. So how much you get? 5 lakh into 1.05 into 2 by 12. Get 87,500. And from the date of right issue, remaining 10 months, total 6 lakh. 6 lakh into 10 by 12, that is 5 lakh. Total we will write 5 lakh 87,500. 5 lakh 87,500. 10 months. Then whatever the profit divided by number of shares like calculated, you get the EPS. Okay, let me just tell you a quick interpretation of this. Quick interpretation of this. What is the consideration received? You have received 1 lakh shares of 15 rupees, means 15 lakh. Received 15 lakh. Now, what is this equivalent amount at fair value? If you were to receive 15 lakh by issuing at fair value, how many number of shares you would have received? Equivalent shares. At fair value. Same 15 lakh. But you want a fair value of 20 rupees. Ex-rate price 20 rupees. So 15 lakh divided by 20. That means you get 75,000 shares. So you are supposed to receive at fair value 75,000, but you received 1 lakh being a shareholder. So what is the additional shares issued? Without consideration. Additional shares without consideration. 25,000 shares. Now this 25,000 shares is like bonus. And if you compute the ratio, 25,000 out of existing 5 lakh. 5 lakh, 25,000, right? So 25,000 by 5 lakh, how much you get? 0.05. That's what this 0.05 means. Bonus element. For every one share you have, you are giving 0.05 free of cost. Bonus element without consideration. So what we should do for basic EPS, for adjusted EPS for previous year? For adjusted EPS, number of shares is 5 lakh plus 25,000 fully, because bonus elements are from the beginning, right? 5 lakh 25,000. So this is what we consider for previous year EPS. For current year, for basic EPS, 5 lakh we take it. 25,000 from the beginning, full months. Then fair value equivalent 75,000 and fair value equivalent only for number of months outstanding, that is for 10 months. How much you get? Calculate for 75,000 into 10 by 12. How much that comes to? 75,000 into 10 by 12. 62,500. And add all 5 lakh 25 62,500, we get 5 lakh 87,500. That's what this number would mean on a interpretation. Okay, so this is about bonus shares and this is about right share. Okay, so hope it is done. Any doubts in right shares, bonus shares? Okay, I'll take this part out then. Okay. Now, what we just discussed for the current year, EPS is called as basic EPS. And for the purpose of comparison, the previous year we restate. The restated EPS is called as adjusted EPS. Adjusted EPS, that is restated EPS. This is history. So this is this year, current, present. This is past. Now we have something futuristic. Past, present, future, 3 tense. Futuristic is called as potential years. That is future year, next year what could happen, assuming the earnings remain same. And potential EPS, all potential EPS we don't show it. We report only if it is dilutive in nature. Dilutive in nature. This is in line with prudence principle. Your current EPS, earnings remaining same, everything remaining same, but because of condition existing on the balance sheet date, the profit can go down, EPS can go down. That possibility of EPS going down should be considered by considering potential shares. What are potential shares? Convertible debentures may become shareholder, convertible preference share may become shareholder, share warrant, share option issued to employee, they may become shareholder. So assuming the profit remains same, but because of these uh, potential shares who are not shares now holder now, but they can become shareholder later. When they become shareholders, if the EPS is going down, is likely to go down because of potential shareholders, that possibility of EPS going down to be reported called as dilutive EPS. Sir, what if EPS goes up? It's called as anti-dilutive in nature. That is not reported. Not reported. That is also possible EPS. That is also futuristic EPS. That is also potential EPS, but not reported. So EPS due to potential shares, which is likely to go down, is called as dilutive in nature. Only dilutive EPS is reported. Anti-dilutive is not reported. Let me give an example. Convertible debentures. Okay, let's say you are having current year profit after tax of 5 lakh and number of shares existing, you have, let's say, 1 lakh. So we say basic EPS will be 5 rupees. Now you have convertible debentures. Let's say it is 8% convertible debentures having face value of 1 lakh, and this will be converted into 2000 shares, convertible into 2000 shares. 2000 shares. Now, when this debentures become shareholders, what will happen to this 1 lakh? 1 lakh will become 1 lakh 2000. Correct? That will increase by number of shares. Now, what will happen to this? That is 1 lakh plus 2000. 2000 will be increased by the shares, potential shares, when they become shareholders. Now, what will happen to profit? Assuming profit remains same, profit after tax, that is 5 lakh. What will happen to interest, debenture interest? Can you tell me, will the profit remain same, profit will increase, or profit will reduce? When debenture becomes shares, number of shares will increase. What will happen to profit after tax? What will happen to profit after tax? Profit after tax will increase because you save interest. So 1 lakh into 8%, 8,000. You save interest. And after even you should consider tax impact. This interest into 1 minus t you should do, because when you save debenture interest, your profit will increase and you have to pay tax also on that. Government will take its share. So into 1 minus t you should do. Here no in tax benefit, but you should remember it is increase in the profit due to interest is interest into 1 minus t after tax. When they are not debenture holder, you don't have to pay interest. You save interest, profit will increase. So how much this will come to now? 5 lakh 8,000 by 1 lakh 2,000. 5 lakh 8,000 by 1 lakh 2,000. That comes to 4.98. 4.98. So this 5 rupee likely to become 4.98, therefore it is dilutive in nature. It is likely to go down and it is reported. Is dilutive? This is reported. Now just imagine small change. If profit after tax is not 5 lakh, is 3 lakh, then what will happen? Basic EPS 3 lakh divided by 1 lakh, which is 3 rupee, and incremental amount, same incremental, same 8,000, same 2,000, 5 lakh plus 8,000 divided by 1 lakh plus 2,000. This will give me 3.02. You see, 3 rupees will become 3.02. It is going to increase. This is called as anti-dilutive, and this is not. So what are the things to be considered for dilutive EPS? Potential shares. When is reported? Only when the potential EPS is below basic EPS. Then what are the things to be considered? Savings in interest, or it might be savings in preference share dividend, and after tax. So interest into 1 minus t should be added to numerator, and denominator should increase by number of shares. Clear? And then you should consider one more thing. It might be chance that it is convertible debentures during the year. Convertible debentures converted or issued during the year. Issued during the year means interest would have been proportionate. Interest would be proportionate for number of months. Number of shares also should be proportionate. So basically matching concept. Numerator profits, interest expense, if it is for proportionately for number of months, same proportion should be applied for number of shares. This will apply 2 times: at the time of issue of debentures, at the time of conversion, because issue can happen during the year, and sorry, uh, this is not 5 lakh, this should be 3 lakh only, not 5 lakh, 3 lakh, 3 lakh, not 5 lakh, 3 lakh. That's a mistake. Is the answer right? Answer 3.02, right? Answer 3.02, right? 3 lakh. Yes. So this proportionate thing will come in 2 times: in the year of issue, because you can issue during the year; in the year of conversion. Conversion can happen middle of the year. In these 2 cases, the interest expense will be proportionate, and the denominator number of shares also should be proportionate. So in the year of conversion, up to the conversion, it will be part of dilutive EPS. After conversion, it will be part of basic EPS. And remember, this interest cost is not the coupon. This is the interest expense taken in P&L account. Interest expense taken in P&L account. Because interest you might pay 5%, 6%, but effective interest may be 6.02. So what will you take it to P&L based on effective interest basis? The effective interest is what should be considered as the basis for computing the incremental profit, incremental number of shares. Any other doubts? Please let me know. Okay, hope you are clear. Please confirm. Shall we go further? Okay. Now, next we have contingent shares. That is, shares issuable after satisfying certain conditions. Contingent shares, like they might say shares issued to employees if they satisfy certain conditions, vesting conditions would be there. Or you can say shares issued by company in the course of business amalgamation, business combination. If the company makes profit of 1 crore in the next quarter, the acquirer gives additional shares. Shares issuable upon meeting certain conditions. When will you consider in basic EPS? And when will you consider in diluted EPS? Dilutive EPS. Basic EPS is included if issued, that is, if contingency is resolved. If contingency is resolved, then from the date of whatever the contingency resolved, from the date of issue, from the date issue to take place, from the date of resolving contingency, from the date of resolving contingency. What if in the current year contingency is not resolved? It's not part of basic EPS. For example, current year, or let's say the shares issuable provided 3 years average profits happens to be 1 lakh. First year you made a profit of 20,000. Not satisfied. Second year you made a profit of 1 lakh 70,000. Third year you make a profit of 1 lakh 40,000. In the third year your average profit is crossed 1 lakh. So in the third year it will be part of basic EPS. From the date on which it is issuable, it will be part of contingent shares, that is part of basic EPS, proportionately for number of months, of course. Proportionately for number of months. Okay. From dilutive EPS, it is considered if condition satisfied, if when the current period is deemed to be the end of contingency period. Deemed to the end of contingency period. What do you mean by this? Let me give an example. Condition to be issued for issuing shares that company should make in 3 years total profit of, let's say, 10,000 rupees. Cumulative profit in 3 years should be 10,000 rupees. In year 1, they made a profit of 4,000. So year 1, you have not cumulatively added 10,000, so it is not there. Year 2, you made a profit of 8,000. So what is the cumulative profit became? 12,000. You crossed 10,000. So this will be part of dilutive EPS. One question you may think, sir, one doubt, sir. What is that? If you cross 10,000 in the second year, don't you think I will take it to basic EPS itself? Because I've crossed 10,000, that means contingency is resolved. Contingency is resolved means it becomes basic EPS. Why will you take it into diluted EPS? Contingency is not resolved. Year 3 is still pending. Sir, year 3 is still pending, but 8,000, 4,000, 12,000 already made. Next year, what if there is a loss of 5,000? What will happen at the end of year 3? 4 plus 8 minus 5. It would be less than 10,000. So you cannot say year 2 they have satisfied the contingency. No, in year 2 contingency is still pending. But if you deem this year 2 is end of the contingency period, year 2 itself is over. For the purpose of dilutive EPS, I am telling you, deem that okay, only 2-year period is considered. That is year end, the date on which you are preparing financial statement is considered to be the contingency period end. Deem it for the purpose of dilutive EPS. Will you satisfy the condition in that scenario? In this example, yes. Yes. For year 2, don't take it in basic EPS, take it in dilutive EPS. Year 3, let's say you made a profit of 1,000 more, contingency period resolved. Year 3, don't take it in dilutive EPS, you take it in basic EPS. Are you clear? Suppose if you make a profit of loss of the 7,000, 3-year condition at the end of third year, not satisfied, you don't take it in dilutive, you don't take it in basic. So when you should consider basic, when the contingency is completely resolved, that shares are issuable. When you consider in dilutive EPS, at the end of the financial statements, that is deemed to be the end of contingency period. Deem it. Will you satisfy the condition? Will you resolve the condition? Are you expected to issue if this were to be the end of reporting period? If this were to be the end of contingency period? If yes, include in dilutive EPS. Otherwise, don't include in dilutive EPS. Hope you are clear in this aspect. Okay, let's go further. So this numerator denominator I've already explained. Date of contingent issued, exchange of liability when settlement takes place without change in the value of capital, like bonus shares, stock split from the earliest period, partly paid, proportionate shares. Adjusted EPS, bonus shares, right shares, and accounting policy changes and all should be adjusted. Contingently issuable shares also we discussed. Dilutive EPS also have discussed. Okay, very good. So this is the theoretical aspects on earnings per share in Ind AS 30. Shares of 100 each, 50 per share was called up on that date, which was paid by all shareholders. Remaining 50 was called up on 1st of September. All the shareholders paid the sum in September except one shareholder having 24,000 shares. Net profit for the year ended 31st March 2011 is rupees 2,64,000 after dividend on preference share and dividend distribution tax of 64,000. Compute basic EPS as per accounting standard 20, you make it as 33. Same method only will apply. Okay, you can do it in two ways. First, let us do it in the month by month method. That is, as on 1st of April 2010, company issued 1,20,000 of 100 each, but called up and paid up was only 50 rupees. And when that is happening, that is till 1st of September. And on 1st of September, the remaining 50 is also called up. So, from 1st of April 2010 to 1st of September 2010, how many shares to be considered? 1,20,000 shares were there, but what you called up is only 50 per share. So we should take only fraction 50 by 100. And that is not for all the year, that is only for up to September. So you have to take again proportionate for number of months. How many months you get? 1st of April to September, April, May, June, July, August. That is 5 months. 5 by 12. That is 25,000. That is from 1st of April to 1st of September. Now from 1st of September to 31st of March 2011, remaining shares were called up, but one person having 24,000 shares did not pay. So what about the full amount then? Only for balance, that is 1,20,000 minus 24,000 shares. How much balance comes to? 96,000 into not 50 by 100, 100 by 100, because the entire 100 rupees paid up. And for how many number of months? Remaining months 7 by 12. How much you get? 56,000. Is number correct? 56? Okay. And not only that, this on 96,000 shares, 100 rupees paid up because people paid the balance 50. But what about those 24,000 shares? Their 50 rupees is still continued. They have not paid the second 50 rupees, but the first 50 rupees is still paid up. Therefore, on 24,000 shares, the first 50 rupees still continues for 7 months. So add it up, so 24,000 into 50 by 100 into 7 by 12. You get 7,000. So total number of shares 25, 56, 7, total comes to 88,000 shares. You can also compute in one more manner. If I consider 1,20,000 shares on which first 50 rupee was paid was there throughout the year. So 1,20,000 into 50 by 100 into 12. So that number you can directly take it as throughout the year 60,000. And on 96,000 shares, only 50 rupee was paid for the number of 7 months. See how much you get? 96,000 shares, 50 by 100 into 7 by 12. You get 28,000. So both ways Total comes to 88,000. Okay, so this is about number of shares. What is the formula for basic EPS? Profit attributable or available to equity shareholders divided by number of shares. What is profit attributable? 2,64,000, and after dividends and after dividend distribution tax. So no need to further adjust anything. 2,64,000 divided by number of shares 88,000. That is rupees 3 per share. Okay, question number 2. Following is the data for company XYZ in respect of number of equity shares during the financial year 1-2. Find out the number of shares for the purpose of calculation of basic EPS as per Ind AS. So it's only about number of shares. We are not calculating any EPS, just about number of shares. Opening balance outstanding, issue of shares, conversion of convertible preference shares in equity, buyback of shares, closing balance of outstanding shares. Just make sure the closing balance matches. 1 lakh plus 75,000 plus 50,000 minus 20,000 is closing 2 lakh 5. It's adding up. Just wanted to confirm that. Okay. Again, this also we can compute from year beginning till the date of events, or we can compute the amount on a total basis. Both way it's fine. Let us do it on individual basis. That is much more comfortable. So type of shares, then weighted average. First one we had is opening balance. One lakh. That is there throughout the year. Buyback will happen, but I'll subtract it later. But this amount is for the full year. I'll take 1 lakh. On 15th June, I think it's dates are also important, so let us do number of days here. 365 by 365. Then issue of shares. Number of shares is 75,000 multiplied by, we have to count the number of days from 15th June. You have to take from 15th June till 31st of March. 289 days. You have to compute 15 days in June or so on, or whatever till 15th. If you compute it, do 365 minus that number. Okay, so how many number of days? If I just count it, in June 15 days, in May 31, 50, 15 days, no? 15 days, I think 30 days in a June, no? There's no confusion there. July 31, August 31, September 30, October 31, November 30, December 31, January 31, February 28, and March 31. Totally you get 289. 289. 289 by 365. Again, if you include 15th also, it becomes 290, but that's fine. 289 is fine. But usually we count from the next day. But for exam purpose, if we include 15th also, there is no issues. It still considers. Okay, how much you get? 58,000, 59,000, 384. Then conversion of convertible preference shares. Conversion of preference shares. So conversion of preference shares, how many shares are given? 50,000, and you have to count from November 8th. So in November we will take 22 days, December 31, Jan 31, Feb 28, March 31. How much total come to? 143 by 365. How much you get? Okay, how much you get? 19,589. Next we have buyback of shares. Buyback of shares should be subtracted, and the date of date of buyback is 22nd February. So from 22nd February, if you count the number of days, 6 days in February and 31 days in March, that is 20,000 into 8 divided by 365. How much? 37 by 365. How much that comes to in negative numbers? 2027. That's all. Okay, just do the total and see how much do you get. Lakh 76, 946. That is the weighted average number of shares for the purpose of computation of EPS. Okay, that is question number 2. For question number 4, it is bonus shares. But before bonus shares, let me give that logic of why that number of shares to be taken from the beginning, and then we look at that problem. Suppose assume your share price is rupees 200 and bonus issued in the ratio of 1:1. So when bonus shares are issued, what will happen to share price? Ultimately, share price is net worth of the company divided by number of shares. But here net worth will not increase, but number of shares will increase. 1:1 bonus. Therefore, actually number of shares will double. So as a result, the share price will actually almost come down to half. So next day, the share price, let's say it has become 103. We should not say that, okay, 200 rupee has become 103, so you have a loss of 97 rupees. We should not say that, because when you had 200, you had only one share. But when the share price became 103, you are actually having 2 shares. So your holding is worth now 206 rupees. 200 rupee has become now 206. You can't say that 200 per share has become 103 rupees. 200 rupee was before bonus, 103 is after bonus. So before bonus, after bonus cannot be compared. So this is the right way of comparison. But normally, we don't express for more than one shares. Though this is right, but we don't do it. What we do is, this previous 200 rupee what you had, this if you compare it to today one share, what would happen? Because this 103 is now, if you take it as one share, what would be this 200 rupee would contain? 200 which gave you the right to purchase 2 shares. 200 divided by 2, and that is 100 rupees. And that 100 rupees you can say that it has become 103 rupees. That 100 rupee is called as adjusted share price. Even in stock market at present, whenever company pays dividend, whenever company pays bonus shares, I cannot compare the previous price and current price as it is. One is after, one is before. To make it comparable, we eliminate the effect of bonus, of right shares and all, and that is called as X bonus after adjusting for the impact of bonus, or also called as adjusted bonus. But basically it means what would be the share price if this bonus was issued on the first day of the company itself. The share price would have been 100 rupees. That is an interpretation of adjusted interpretation of this adjusted share price. Same thing applicable for bonus shares on EPS. Suppose company had 30 lakh rupees profits, and here number of shares were, let's say, 10 lakh. So 30 lakh by 10 lakh, you get EPS of 3 rupees in the year, let's say, 2018-19. In the year 2019-20, assume the profit remaining same 30 lakhs. But they did a bonus of 1:1. So 10 lakh shares became 20 lakh shares. And 30 lakh by 20 lakh means you get 1.5. If you look at only EPS, what it would give the picture? The share price EPS reduced by half. That means company's performance has gone down. But that is not the case. It is just that number of shares have increased without any increase in the value of the company. So for the purpose of comparison, we take this 10 lakh also as 20 lakhs, so that that comparison makes sense. So this impact of bonus shares, impact of right issue, all these things are called as adjusted EPS. That is, for the purpose of comparison, even though the event has taken place in the current year, we give the effect as if it has taken in the earlier year itself. That is called as adjusted EPS. Basic EPS is for the year, present tense. Adjusted EPS is for the previous years. That is only for the purpose of comparison for the events that have taken place in the current year. You give the effect as if it has taken in the previous year itself, and that is called as adjusted EPS only for the purpose of comparison. We don't go to previous years and change the previous year's EPS. We don't do it. It is in the current financial statements only for the purpose of comparison of previous year's numbers. So that is present tense and past tense. One future tense also will come. What would happen EPS to the future years, and that we call it as diluted EPS. We'll discuss that part after this problem. So question number 4. Net profit for the year 2011 18 lakh, net profit for the year 2012 60 lakhs. Number of equity share outstanding till 30th September. Bonus issue on 1st October was 2 shares for each equity share outstanding on 30th September. Calculate the basic EPS and corresponding previous year figure for comparison. So basic EPS is profit divided by number of shares. Profit is for the year 2012 60 lakhs divided by number of shares were 20 lakh, but that is before bonus issue. Bonus issue made 2 shares for each equity share outstanding. That means bonus shares are issued 20 lakh into 2, which is 40 lakh. Actually, then total number of shares becomes 60 lakhs. So 60 lakh rupees by 60 lakh shares, that becomes rupee 1. Don't worry about the date of issue, that does not matter. It is given effect as if it is issued on first day of the company itself. So date of bonus issue don't matter. You take for the full year, don't take any proportionate number of shares. Basically because it does not give you any benefit. Bonus shares does not give any additional resource for the company to make more profits. This is basic EPS. Then adjusted EPS, that is for previous year for the purpose of comparison. Previous year profit is 18 lakhs. And number of shares should be what number? Previous year there were only 20 lakhs. Bonus share issued in the current year, but for the purpose of comparison, I take bonus in the previous year also. So previous year also I'll take 20 lakh plus 40 lakh, 60 lakhs, which is 0.3 per share. And these are all were there at your IP syllabus. These are all nothing new. But still in examination, since Ind AS is part of your syllabus, they can ask EPS calculations also. So 2011-2012, number of shares outstanding prior to right issue price. Last day to exercise the rights is 1st of March. Right issue is 1 share for 5 shares outstanding. Fair value of 1 equity share immediately prior to right issue was 21. Compute basic EPS assuming the calendar year is accounting year. So this is the impact of right shares. Right shares are the shares offered to existing shareholders before it is offered to public. And usually these right shares are issued at a concessional price below the fair value. So fair value in this case is 21 but issued at 15 rupees. So I have given them some discount. This discount has some bonus element if you compute the equivalent number of shares. And for that bonus element, you should consider as if it is issued from first day of the previous year itself, like the way what we did for bonus shares. Remaining shares which are issued at consideration, you take it like any other shares. That is date of issue. From that date, you take proportionate number of shares. And how that bonus element is given effect is by computing one factor called as adjusting factors. And adjusting factor is formula is theoretical fair value per share before right divided by theoretical X right price. It's called as theoretical X right price. And when you say X right price, please don't think about the right of your X. It means excluding the right. That means once the right shares are issued, what is the theoretical price? What is supposed to be the price? Because actual price always available in the market due to fluctuations. That is supply demand factors. But if you consider everything same, only one additional point is additional right issue, what would happen to the company share price? Okay. What is the net worth of the companies before issue of bonus? Number of shares company had before issue of right share was 5 lakh. And what is the value of the company per share before right issue? 21. So 5 lakh into 21 is the value of the company before bonus or before rights. And after rights, they have issued 15 rupees for how many shares? Issue price 15 rupees for what is the number of shares? 1 lakh. that is 1 lakh into 15 rupees divided by total number of shares, which is 5 lakh plus 1 lakh. So simplify it and tell me what do you get. 5 lakh into 21 plus 1 lakh into 15 by 5 lakh plus 1 lakh. You get 20 rupees. So 21 rupee has become 20 rupees. That is because you're issuing the shares at a concessional price. That 1 rupee basically represents the value of right for every shares held. This is for every shares held. So if you want to compute on number of shares, that is 5 shares are there and 20 rupees. You can also compute this in one more manner. What are the share prices were given? Fair value was 21 and the right issue price is 15. And what is the rights ratio, issue of right shares? 1 for every 5 shares held. So 15 into 1 by 6, 21 into 5 by 6. Because 5:1 is the ratio. Existing is 5, the new one is 15 rupees. If you take this number, that also should give you 20, you can cross check. 21 rupees into 5 by 6, 5:1, and 15 rupees into 1 by 6. That should also give you mathematically 20 rupees. On a ratio basis. Anyway, so theoretical X right price 20, and in your SFM they can ask you this question: what is the value of right? Impact of issue of right. What is the value of right per share? In your security analysis chapter, all these things were there. Hopefully your SFM faculty has done problem on these areas. If not, we are doing it, make use of it. Okay, theoretical X right price. Now we'll come for adjustment factors. Adjustment factor is what is the fair value before right, fair value before right divided by this X right price, theoretical X right price. Basically before by after. What was the number before and what is the number after? That is 21 divided by 20, 1.05. 21 by 20, 1.05. That basically means 1 rupee worth is now becoming 1.05. That is 0.05 is a bonus element indirectly, the value of the right for in a ratio basis. But anyway, you don't worry about that part. Let us just understand how to make use of this. This is calendar year as accounting year. So I'll do it in columnar basis, 2012 and 2011. Profit is 15 lakh and 11 lakh divided by number of shares. How much number of shares was there previous year? You had 5 lakh, but this bonus element you have to consider even for previous year. That means previous year I should take 5 lakh multiplied by 1.05. It's like a bonus shares issued. Even though current year effect is first day of the previous year. So I think you get 5 lakh 25,000. So 11 lakh by 5 lakh 25,000. You get 2.1. This 2.1 is called as adjusted EPS because previous year you would have done 11 lakh by 5 lakh only. That is in their previous financial statements. But for the purpose of comparison, we have to adjust this bonus element, adjusting factor. Current year, how do you do it? You take 5 lakh into 1.05, but only up to the date of issue of rights. That means for how many months? Only till March 1st. This is a calendar year, so you start from January and February. So 5 lakh into 1.05 into 2 by 12 plus, now you take the total number of shares for remaining months, that is 6 lakh into 10 by 12. 5 lakh into 1.05 into 2 by 12 plus 6 lakh into 10 by 12. I think number of shares comes to 5 lakh 87,500. So 15 lakh by 5 lakh 87,500, 2.55. And just to remember that adjusting factor, write one note regarding when should be considered and till what time it should be considered. For adjusted EPS, number of shares is multiplied by adjusting factor. For adjusted EPS, number of shares is multiplied by adjusting factors. Adjusting factor. Just take a look at this example what we did. Is it multiplied? For computing adjusted EPS for the year 2011, 5 lakh multiplied by 1.05. That is, number of shares is multiplied by adjusting factors. That is, this is the adjusted EPS 2.1. Next, below that, for computing basic EPS, adjusting factor to be applied, up to the date of right issue. After which total number of shares are considered. Total number of shares are considered for the remaining period. Okay, and see that is what we have done here. Up to the date of issue, that is for first 2 months, we have taken this adjusting factor. After the date of right issue, that is for remaining 10 months, we have taken total number of shares. So up to 1st of March, adjusting factor is applied. After 1st of March, for remaining 10 months, total number of shares is considered. That is the impact of right issue. Again, these are all were there in your IPCC level. Bonus shares, right shares, convertible debentures, and so on. Okay, so this is question number 5. Before we go further, let me just give you interpretation of this adjusting factor in one more manner. Don't consider that again interpretation too much, but only for our understanding. That is not required for exams. So only for our understanding, don't interpret beyond certain level here. Okay, what is the consideration received by issuing right shares? 1 lakh shares multiplied by 15 rupees, 15 lakhs. If these 15 lakhs were shares issued at a fair value after right price, what would have been the number of shares? Number of shares at X right price, fair value, X right price, 15 lakh divided by 20 rupees, 75,000 shares. But what is actual number of shares? Now, actual number of shares is 1 lakh. So, what is the bonus element? Free shares issued, equivalent units, 25,000 shares. So, for previous year, for 2011, number of shares will be 5 lakh plus 25,000, because bonus issued is considered from the first day itself of the previous year, which is what we have also considered. But how did we get that 5 lakh 25,000? 5 lakh multiplied by 1.05. And here we did 25,000. That is, ultimately amount is 5 lakh 25,000 is given effect. And for 2012, current year, 5 lakh is taken, 25,000 is bonus shares, that should be taken, but this 75,000 fair value to be considered only for certain number of months after the issue of right issue. It is there in the current year for a period of 10 months. So 75,000 into 10 by 12. So how much do we get? 75,000 into 10 by 12 is 62,500. So if I add all, 5 lakh 25,000 plus 62,500, you get totally 5 lakh 87,500. And this was a number that we also have taken when we did 5 lakh into 1.05 plus that 2 by 12 and 10 by 12. Ultimately it comes to same, but as I told you, this you don't try to apply it everywhere, but just for your understanding how this interpretation of adjusting factors 1.05 works. So basic meaning of 1.05 is for every 1 rupee shares, it is given 1.05 worth share. So bonus element of 0.05, that is the value of the right bonus element is implied. Anyway, that is again right shares. Again, I don't want to do too many problems because these are all just recap of what you would have already learnt and forgotten by now, because you strongly believe in FIFO, first in, first out. Forget first, whatever you learned first. Okay, that is question number 5. Okay, so what is pending is diluted EPS and the order of dilution of EPS, that will take up in the next session. So 7:25, take a break of 10 minutes, 7:35 will be 10 minutes. Calculate the diluted earnings per share from the following information: net profit for the year, number of shares outstanding, number of convertible debentures, each debenture is convertible into 10 equity shares, interest expense for the year, tax relating to interest expense. Okay, first we will compute basic EPS, because only then we can comment whether it is having dilutive impact or anti-dilutive impact. So first compute basic EPS. 85,50,000 divided by number of shares, which is 20 lakh. Then we'll come to incremental EPS, that is incremental profits and incremental number of shares. Interest, they only have given interest expense for the year 6 lakh. After tax, 6 lakh into 1 minus 0.3, 4 lakh 20,000.
Okay, this is the interest which is saved. But can you tell me one thing? What is supposed to be the interest expense ideally for the year? Annual interest? This is 1 lakh debenture of 100 each at the rate of 8%. 1 lakh debentures of 100 each at the rate of 8%, that is supposed to be 8 lakhs. But what they have given is 6 lakhs. So why do you think it is less? That means debentures would have been issued in the current year. Therefore, accrued expense is less. So when you take the lower amount of interest, even your number of shares should be proportional in nature. Whatever the proportionate interest expense you considered, number of shares also should be proportionate, because when you say incremental EPS, numerator and denominator should be matching in nature. If your interest expense is for part of the year, your number of shares also should be proportionate. So what is the proportion of interest expense? Proportion of interest expense, 6 lakhs out of 8 lakh means you get 0.75. Basically 9 months, but 0.75 is what we'll take it. So what should be the number of shares, incremental shares? We are supposed to take 1 lakh debenture multiplied by, each debenture is convertible into 10 equity shares, supposed to be multiplied by 10. But because of this proportion, I multiplied by 0.75. So 1 lakh into 10 into 0.75. 7 lakh 50,000. So what is incremental EPS? Profit is after tax, how much we got it? This number, 4,20,000, divided by number of shares, 7,50,000, and that is 0.56, and 0.56 is below 4.275. Therefore we say this is dilutive in nature. This is dilutive. Since it is dilutive, I will consider as incremental shares and incremental profit for the purpose of reporting dilutive EPS. So dilutive EPS equals, you take the existing profit, which is 85,50,000 plus incremental profit 4,20,000 divided by existing number of shares 20 lakhs plus new number of shares 7,50,000. 85 lakh 50 existing, 20 lakh shares existing, incremental profits 4,20,000, incremental number of shares 75,000, and that is 3.26 dilutive EPS.
Okay, so let us take up this exam problem, number 2020. The following information is available relating to Space India Limited for the financial year 1920. Net profit attributable to equity shareholders, number of equity share outstanding, average fair value of one share during the year. Potential ordinary shares, options, 900 options with exercise price of 75. Convertible preference shares, 7,500 shares entitled to cumulative dividend of 9 per share. Each preference share is convertible into 2 equity shares. Applicable corporate dividend tax 8%. 10% convertible debentures, rupees 10 lakh, and each debenture is convertible into 4 equity shares. Tax rate 25%. You're required to compute the basic and diluted EPS for the financial year 2019. Okay, so when we have multiple potential shares, we have to understand the order of dilution. For that, first thing you calculate basic EPS. Basic EPS, the profit attributable to equity shareholders, 90,000. Attributable to equity shareholders. So preference share dividend is already subtracted. If they're just given profit after tax, we might have to subtract preference share dividend. It's attributable to equity shareholders, so preference share dividend is already subtracted. Divided by number of shares. So 90,000 divided by 16,000. 5.625. Okay, then dilutive EPS. The first thing I should understand is order of dilution. For that, we have to calculate incremental EPS. So whatever is the class of shares, then incremental profits, incremental shares, and when you divide one by another, we get incremental EPS. And then we have to give a rank order, lowest to highest. We have options, convertible preference shares, CPS, and convertible debentures. Okay. Coming to options, incremental profit is 0. Incremental shares, bonus element. What is the fair value? 90 rupees. Issue price, 75. So what is the concession? 90 minus 75, 15 rupees out of 90 rupees. So concession is 15 by 90 multiplied by number of shares, 900 options. They don't have any incremental profit, 0. So number of shares, 90 minus 75 by 90 into 900, 150 shares. 150 shares. Incremental EPS, 0 divided by 150, that is 0 only. Convertible preference shares. So when you have preference share becoming equity share, preference share dividend need not be paid. To that extent, your profit will increase. Preference share, 7,500 preference share into 9. And you have dividend tax. This dividend tax also need not be paid now because the debenture becomes shares. That also I'm going to add. 7,500 into 9, then that 8% plus 8% you can do. 7,500 into 9 plus 8%. It's 72,900. Number of shares. Each share is convertible to 2 equity shares. So ratio 1:2. 7,500 into 2, 15,000. Incremental EPS 72,900 divided by 15,000, 4.86. Convertible debentures, uh, 10 lakh, rate of interest 10%. So 10 lakh into 10% and after tax. So when you save interest, interest income, your profit will increase. You have to pay tax. Tax rate 25%. So 1 minus 0.25. Actually, for dividend, 1 plus 0.08. For debenture, for preference shares, I did 1 plus tax rate because tax also is saved. But whereas for debenture, you reduce tax. So please observe this carefully. For preference share, we are adding tax rate. For debenture, we are subtracting tax rate. Why? Because the dividend tax, when you don't have dividend, dividend tax also will not be paid. So you save dividend, you save dividend tax. But for debenture, it's not like that. Debenture is an expense. So when you save expense, increase in profit, you have to pay tax. So in one hand, I'm adding tax. On other hand, I'm subtracting tax. Please observe that difference carefully. 10 lakhs into 10%, 2.75, 75,000. Incremental shares, convertible into 4 equity shares. So 10 lakh rupees, face value 100 each. So 10 lakh rupees divided by 100. So I think you get 10,000 and multiplied by 4. 10,000 debenture multiplied by 4. So that is 40,000. 75 by 40,000. 75,000 by 40,000. 1.875. Rank order them lowest to highest. 0 get the first rank, 1.875 second rank, 4.86 third rank. Okay, just for one curiosity sake, I'll ask one question. Try to answer it. If this is not 1.875, if it was 5.875, which rank you would have given for debenture if it was 5.875? If you have given for this last one 5.875, which rank you would have given? It would not be 3. You know why? It is more than 5.625. No, it would not even consider it at the first place with no rank. Rank will provide provided they are lower than basic EPS. All are lower and therefore we are giving them rank. If any of them is more than 5.625, that is anti-dilutive in nature, straight away we will ignore it. Keep this point in mind. Okay, then let's go for anti-dilutive EPS calculation. Sorry, dilutive EPS calculation. Okay, so order of dilutive EPS we calculated. Let's go for one by one. order of dilutive EPS. Basic formula you understand. Whatever the net profits or profit after tax, we divide by number of shares, we'll get EPS. So we'll start with basic EPS, which you already know. Still, I'll follow the process. 90,000 is profit after tax. Divide by number of shares 16,000. You get 5.625. The reason I'm starting is this is the base. Only when I go further, if it starts increasing, I'll stop at that point. So I'll start with rank 1. And rank 1 was options. And what is the incremental profit? 0. So this becomes 90,000. And incremental number of shares? 150. So 16,150. 90,000 by 16,150. 5.57. So please observe, it has reduced. If it starts increasing, I'll stop at that point only. I don't even go further. Then rank 2. Rank 2 is convertible debentures. And please understand, when I say rank 2, I don't take only rank 2. I'll go on cumulative basis. For the previous line item, I will add. So incremental profits was for debenture 75,000. And the shares 15,000. Cumulative basis, you have to keep adding. So 90,000 plus 75,000, 1,65,000 divided by, I think this is 31,150. No, not 15,000, 40,000, right? Sorry, 40,000. Debenture is 40,000. So 56,150. So 1,65,000 by 56,150, you get 2.94. Again, it has reduced. Rank 3, preference shares, add cumulatively. Dividend is 72,900. So 1,65,000 plus 72,900. 2,37,900. Number of preference shares 15,000. You get 81,150 something. 71,150. So 2,37,900 divided by 71,150. 3.343. 3.34. And you see, this started increasing, right? It's increased. So this is called as the anti-dilutive. This will be anti-dilutive. And what one thing mistake you should not do? Do not compare 3.34 with basic EPS and say it is lower than basic EPS, sir. So dilutive EPS, sir. Don't think on those lines. We have to report lowest EPS possible. We might use only preference share, we might use only debenture, does not matter, but lowest EPS is our target to be reported. So what is to be reported? 3.34 increased. So don't go to that one. The previous one, 2.894 is the reportable dilutive EPS. This is the reported dilutive EPS. 2.94 is reportable dilutive EPS. If you want, you can add a separate line. 2.94 is the dilutive EPS reported. This format can be used in exam as well. This format only should be used. This is what Institute also has followed. The order of dilutive EPS. Okay, so take a look at the calculation. See if you have any doubts. Charts and calculations all India seems to be easy. Of course, it's easy because it's in front of you, right? But in examination, that chart should be in your mind. So that's the challenging part. Of course, if chart itself is not there, it would be even more difficult. But having the charts and calculation would not be sufficient. You have to, uh, you should be able to replicate the same thing in exam as well. Okay. Okay, fine. Let's go further then. Good. Okay, so let's take up this problem, exam problem, July 2021. On 31st March 2019, the issued share capital of B Limited consisted of 20 lakh ordinary shares of rupees 1 each. On July 1st, 2019, the company issued 25 lakh 8% convertible loan for cash at par. We are on 31st of March 19, so next year, in the year 1920, after 3 months, they have issued convertible loans. Each of rupees 100 of the loan stock may be converted at any time during the years ending 2024 to 2027 into the following ordinary shares set below.
If you convert it on 31st March 2024, you get 135 shares. If you convert it on 2025, you get 130 shares. If you convert in 2026, you get 125 shares. You get 2027, you get 120 shares. So many shares you get. As you delay your decision, the number of shares keeps getting reduced. So earliest you exercise, you get higher shares, and the latest oldest you exercise, you get less number of shares. But the problem is, earlier now the value per share may be less, later value per share may be more. That is a decision as an investor you have to make. If the loan stock is not converted by 2027, they would be redeemed at par. Then we can't give more time. Please close it. It is assumed that the return equity conversion option is accounted for as a derivative liability and marked to market through profit and loss. The change in the option fair value reported on 31st of March 2020-21 amounted to loss of 5,000, 5,300 respectively. 20 is the first year, 21 second year. Further, it is assumed that there are no tax consequences arising from these losses. God bless them, no deferred tax impact. The profit before interest, fair value, movement, and the taxation for the year amounted on 31st March 20 and 21, 16 lakh 50, 17 lakh 90 respectively, and relates wholly to continuing operations. The rate for tax both the years is 33%, including cess and surcharge, if any. Calculate the basic and dilutive EPS for the year 2021. Okay, let's do the easier one, which is basic EPS. Profit we have 16 lakh 50,000 and 17 lakh 90,000. We have to this is profit before interest. So first you should subtract interest, subtract tax, profit after tax you arrive, then you divide by number of shares, you give you basic EPS. And that too, please observe, it is issued on 1st of July 2019. On CA day, they have taken loan, they've issued loan. So you are going to calculate interest for a period of 9 months from July to 31st of March. So 25 lakh into 8% into 9 by 12. 1,50,000, and this year, next year you don't have to do into 9 by 12, you can take the full 2 lakh. So that's what they have done. 17 lakh 90, 16 lakh 50, subtract the interest, bracket is missing. Then the change in fair value, yes, I forgot to tell, this loss change in fair value, this is before fair value change. So, in financial instrument we discussed fair value change should be reported. So loss, subtract 5,000 and 5,300 respectively. I assume it is not cumulative in nature. Have they given fair value change or just a fair value? Change. Okay, they have given specifically. The change in the option fair value is this. Otherwise, if they tell you fair value 5,000, 5,300 means I will take 5,000 in the first year, 300 in the second year. If they use the word fair value, they use the word change in the fair value. So clearly, they have given the change directly. So 5,000 is a loss in previous year. 5,300 is a loss in the current year. You get profit before tax, subtract profit, subtract tax, you get profit after tax. Divide by number of shares, you will get basic EPS. This is a straightforward one. This is a basic EPS. Still, take a look at this. See if you have any doubt in the calculation part of it. The option to convert from loan to shares. The company has given the option for the borrower to convert the shares into options. That option value they are valuing, the option to convert. So when you give somebody else the option to buy the shares from your company, it is actually you are going to sell the shares. You are having obligation to sell the shares. Indirectly, like you are a option writer. And that option writer, fair value, they're changing. Call option to be specific. You are having obligation to sell. Okay. This is regarding the basic EPS. Then going towards dilutive EPS. Dilutive EPS, don't straight away go and calculate dilutive EPS. First, you have to understand the impact. Is it dilutive in nature? For that, we calculate incremental profits by incremental number of shares. Let's see whether it's basic EPS comparison purpose. So to test whether the convertible are dilutive, the saving after tax resulting from the conversion amounts to hundreds into 8% into after tax. 33% means after tax 1 minus t will become 67%. So 100 into 8% into 67% into number of debentures. I think 25,000. Yeah, 25,000, or you could run directly, 25 lakh into 8% into 67%. How much you get? Oh, they are doing it on per share basis. Does not matter. Uh, let's do in our way only. 25 lakh into 8% into 67%. 1,34,000 divided by number of shares. Number of shares will be 100 each, so 25,000 shares. You get 5.36. They have done directly on per share basis because the ratio is 1:1. The one share, one debenture, they did directly 5.36. Okay, so 5.36 is the incremental per share basis. But what is the basic EPS? Oh, see, this is higher, no? Then just 1 second. Uh, okay, and then what the standard says is this is the existing number of shares which we are going to issue, and if there are any possibility of issuing more number of shares, you take the maximum possible shares possible, because dilutive EPS is what we want to report. So number of shares as much you show, the EPS will be as less as possible. More number of shares, EPS will reduce. So among these four possibilities, the maximum possibility is 135, again on the prudent basis. So we will take prudent basis as 135. So 5.5, 5.57. What is that? 0.21. Is that, have they taken any fair value have added back? Yeah, that is also making sense, because when you convert into share, this fair value changes. You're not going to account for it. So 5,300 divided by 25,000. Oh, they have done it here. 5,300 by 25,000. Or what you would have done, what we okay on this, they're assuming no tax impact. Yeah, there is no tax impact, no, because this is not allowed for tax purposes. So what you do directly, let's forget about their calculation for the time being. Let's do it once more. 25 lakh multiplied by 8% into 67% plus 5,300 divided by 25,135. Directly you can divide. No, 25,000 is existing plus 135. 25,000 shares and 135 additionally you are going to issue it. If you are converted during this period, these number of ordinary shares you get extra. Therefore, you can directly divide by 25,135. So will you get this number? 4 paisa something. Are you getting it? 0.004. Just try it once more. 25 lakh into 8% into 67% plus 5300 divided by 25,135. Okay, 5.54. Why, how come they are getting? No, no, here they have divided again. There, no, then 5.57 they got. Then they divide by 135. You get 5.57 by 135. Yeah, that's what you get. That's in 4 paise. Maybe there's rounding off involved, maybe because too many spices are there. Maybe for that reason. Let's not worry about it. Okay, we got 5.57. We got 135 shares. 5.57 rupees by 135. Hopefully, you get that 4 paisa. And 4 paisa is definitely lesser than 53 paisa. So it is dilutive in nature. While adding the previous year, you should be careful. Please take a look at this. This is profit given 10 lakh 60,000 and 10 lakh profit after tax, right? 10 lakh 60,000 and 10 lakh. And we add back interest 2 lakh. And here we add back only 1 lakh 50,000. Here we add back 5,300. Here we add back 5,000. Tax relief 30% on 2 lakh, 33% on 2 lakh, 33% 1 lakh 50,000. Adjusted earnings equity and divide by number of shares. How much number of shares we will divide? In the current year, we will divide by existing number of shares is 20 lakh plus the number of shares what you consider, some 25,000 something, right? Yeah, 25 lakh. No, okay, okay. This is not 25 or 135. That's why you not get the answer. It's 135 for every 100 shares. This is not each rupee 100 nominal of the loan stock may be converted at any time during the year into the number of ordinary shares. So the number of shares is not 25,000. So what you should do is 25 lakh. So one debenture will give you 1.35 shares kind of thing, approximately, or 100 each or this one each. What is the loan amount? Okay, 25 lakh rupees each at par at rupees 100 of the nominal value. Okay, so rupees 20 total number of shares, if I analyze 25 lakh divided by 100 multiplied by 135, that will be the number of shares actually going to be issued. 33 750 shares. Okay, into 100 means you get 33 lakh 75,000 shares. For every 100 rupee face value, you get 135 shares. For 25 lakh, so 25 lakh by 100 into that 135. I don't know whether you're confusing. I'll just explain once more. If the face value is 100 rupees, I'll say rupees hundreds. Number of shares 135. And rupees, how much the loan amount? 25 lakh. So number of shares 25 lakh into 135 divided by 100. 33 lakh 75,000. Maybe this number, if I take it, our per share also may come. Let's try it out once. 33 lakh 75,000, right? That number. Okay, let me write it. Okay, then try it out from the beginning. 25 lakh into 8% into 67% plus 5,300 divided by not just 33 lakh. Incremental, no, correct. Divided by 30 lakh 75,000. Yeah. Now I think we get that 0.044 pies. Please write down somewhere so that you can connect it later for this question. Hope you got that 4 paisa. I'm not sure how they got it, but anyway, we got the method by using the 33 lakh 75,000 shares. So when I divide by the when I computing dilutive EPS, what process we are going to apply? 11 lakh 99,300 divided by 20 lakh existing shares plus 33 lakh 75,000, that 53 lakh 75,000 we are going to divide. This is fine. Previous year you should be careful. I will not take 33 lakh 75,000 because interest expense I took only for 9 months. The number of shares also I should do 9 months. So 33 lakh 75 into 9 by 12. Because previous year interest I paid only for 9 months. Number of shares also should be for 9 months, proportionate. What I'm trying to tell you is, when I do profit after tax plus interest, denominator number of shares existing plus what is converted. When you do interest only for 9 months, this conversion also should be done for 9 months. That's what I was trying to refer. And these things you don't have to worry, because as per dilutive EPS concept, we should take whatever is maximum possible number. If it was reverse, like 120, 125, 130, 135, I would have taken 135 only. So basically, I want to make sure that when I'm reporting EPS, it should be as less as possible. Number of shares should be as more as possible. So read this sentence. I also did not read carefully. Each of rupees hundreds is giving 135 shares. So number of shares is 33 lakh 75,000. Which one? No, you're saving interest. When you convert the loan into shares, interest no longer payable. You save it. You pay more tax. Correct. You pay more tax. Interest will increase the profits. Oh. Avoidance of saving in tax. Actually, what you can do is, you can directly start from 17 lakh 90,000. No, we have subtracted interest, we have subtracted fair value, then subtract tax. Rather than that, I'll start from this number and subtract tax. That interest, savings and all would have taken automatically. I mean, if you want to do that, but in some other problem, this information may not be there. Also, this 33%, just check on what amount they have calculated. I would like to verify that. 33% on, not on 15 lakh 84,700. Spend 1 or 2 minutes on this. It is not on 15 lakh 84,700. It is 33% on 15 lakh 90,000. Because this is not allowed for tax purpose, and therefore while adding also I've taken only 5,300, and here I have not done into 1 minus t. While calculating tax, I have not subtracted tax on 5,300. While reversing also I will not add. Vice versa, both places the tax impact will not be considered. Because they said ignore deferred tax. Had we considered deferred tax, this would have come. On this also would have taken tax impact. Anyway, they made at least one help by telling that apply that point carefully. In fact, there was a typing error in the institute material. A similar question was there in the study material. They applied in the question they said no tax impact, but in the answer on 5,300 also they applied tax rate. That was a mistake. If you have slightly old material, that mistake still was there, and then later they have rectified it. So hope you got this point. 17 lakh 90,000 minus 2 lakh. On that you apply 33%. That means on 5,300 it is not allowed for tax purpose. Similarly, while calculating this dilutive impact as well, here also you see 5,300 I have taken, I have not multiplied by 67%. Okay, I'll go further.